Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Just checking the mic there to make sure it's squared away. You notice my haircut. My wife cut my hair tight on the sides like I've always liked it, easy as heck to comb, just like that, and you're good to go. So today we're going to talk about a critical portion of retirement planning that you need to be very, very aware of that I find a lot of people are not, and that's the required minimum distributions that you're going to be dealing with when you hit 70 and a half. Now, a lot of people, in particular, if you're 55 years old, you might just say, oh, that's way out in the way. I don't care that much, Josh. I don't really need to be planning for that. In fact, I've seen that happen more times than not. And I say, no, you're wrong. You do need to be planning for it, and you need to be planning for it right now. And let me share you why. So we'll just say, remember we got Jane and Bob. Jane and Bob. So now I'm going to say Jane is working. She has $400,000 in her 401k right now. She's 55 years old. She's not going to put anything else into it. She's not going to pull anything from it. She's just going to let it sit there until she's 70 years old, in which case she has to take a distribution from it. We're going to say she's going to get 6% a year on that money. And we're going to find out that her account, $400,000 at 6% a year, not putting anything, not taking anything out. When she's 70 and a half, essentially, needs to take required distributions, she's going to have $958,000 in there. So what we're going to use then is we're going to use my friend who I know via the email, Mr. Pistolka. I think his first name's Dan, but a real nice guy out of California. He was like the CFO of the California Credit Union or something like that. It's just a great guy. Lots of spreadsheets that he has available for free for you. Tons of stuff that way over my head. I mean, just future value, bank interest, and leap years, and just mortgage loan pool pricing table with CPR, CDR, and loss severity. CPR, I thought it meant to resuscitate somebody with breath, but apparently that means something to CFO types. But there's also lots of different stuff in here that I use in terms of required minimum distributions, lots of stuff that he's put up here, and we're going to use one of his sheets that's out there for you to use too, as a matter of fact. So pistolka.com, could not recommend it enough. A CFO in a bank, they need to know everything under the sun from how money works. CD rates, maturities, mortgages, and all that. I mean, just the brain power that goes into that just boggles my mind, actually. But the fact that he puts it out there for all to see and it's free is just what a wonderful guy and just what a wonderful tool. All right, so we're going to go back to Jane. And remember, she started with $400,000 15 years ago. Now she's 70. What did her account grow to? Well, we already showed you that. I got to delete that. $958,000. All right, so she has $958,000. We're going to use this sheet to say what her required minimum distributions are based on that 958. Now, what we see here is that we have a RMD factor, 27.4, 26.5, and so on and so on. So in the first year, her RMD factor is divide the account balance by this factor, 27.4. And that gives us this amount right here, we'll just say $35,000. That's a 3.65% distribution amount, 3.65. So the next year we take 1 divided by 26.5. She has a 3.8% distribution amount roughly. And then the next year, 1 divided by 25.6, she has a 3.9%. So you can see it starts getting larger, the distributions amount, as you get older. Now, the irony of it, because she's getting 6% a year rate of return, and that's not crazy talk. I mean, if you're looking at retirement, you're probably getting, in that case, 65% in stocks, 35% in bonds. And, that's going to be, we're going to calculate that as a linear rate of return. Nothing's ever linear in the market. But in this case, that's all we can do, because this is what we got to base our required minimum distribution, in which we can base our potential for taxes on this amount right here. Now, the market goes up, market goes down. We're just going to use a linear rate of return because that's what the tax tables do. The IRS minimum distribution requirements are based on a linear rate of return. And so basically what we're saying is at the end of the day, when Jane's 70 and a half, she had to get a check from the IRS to pay taxes to the IRS of roughly $35,000. But because the account was growing at 6%, which means it's growing at more than the amount she was taking out. So she's getting this kind of growth. The amount she's taking out is way down here. their account's still growing. She started with 958. She took out 35,000, and she has 980,000 when all said and done. So what happens now? Let's fast forward a little bit. So now look at this. Now she's 83 years old. She has a $1.44 million in there. And she's been taking out 60,057. So she's been making more money than she's been distributing up until the age of 83 when it starts going the other way. So now she has 1.44 million. And the next year she has 1.143 million because now the factor of 16.3 is about 6.1%. So now she's taking 6% a year out of her portfolio, a little bit more than what she's getting on a rate of return of 6%. And now we're starting to see some distributions actually eat into her portfolio value. So let's just say we have Miss Jane dying at the age of 90 years old. Well, at a 6% rate of return, she still has over $1 million in this account, and her RMD in this case is $90,000. $90,000 is her RMD. 12 is her factor, which means her distribution percentage is 8.33%. She has to take more than what her portfolio is growing in which to pay tax on that. But it gets worse. Now she dies, her spouse is going to inherit this, and he will still have RMDs, required minimum distributions, based on his life expectancy, which we'll get into a different episode here, and he's going to have to pay tax on that. When he dies, his heirs are going to have RMDs based on their life expectancies, and they're going to have to pay income tax on it as well. And typically, they're still working, which means their income tax rates will be much higher than it was for a retiree. And we're going to show you that in our next episode of how the tax consequences of these large required distributions are brutal, not only to Jane and Bob, but to Bob when he survives Jane, and certainly going downstream to the children. It's brutal, and a lot of people overlook that, and the reason is because they see the front end of the RMDs tables, if I can get to go up there with me, and they say, oh man, the RMDs aren't that much. It's only 3.5, 3.6% in the first year. Yeah, but it's growing each and every year until you have significant RMDs. Now, what do RMDs do? They make your Social Security taxed. On top of that, they also have an effect on your Medicare Part B and Part D. And again, this will be another episode. We'll talk about how just a simple RMDs of significant amounts combined with your Social Security income can really put you up against the wall when it comes to your Social Security taxation, income taxation, as well as your Medicare premiums that you have to pay. Now remember, Jane and Bob were not wealthy. They started with $400,000 when Jane was 55 years old, which is a nice lump sum, don't get me wrong. But it's not a significant amount of money by any stretch of the imagination. But even that amount of money can lead to significant distribution amounts, which can have a horrific effect on her tax consequence for sure. So we're going to talk about that next time because I think it's pretty important to understand how your required minimum distributions are not your friend and what you can do to minimize, if not outright avoid those. And right now with Jane and Bob being 55 years old, they are in the golden years of tax planning. There's no better time to start the tax planning than right now if you're in your 50s. It's just all there is to it. And I'll show you next time exactly what I mean. All right, so don't forget to subscribe, put comments down there too. What's your experience with the required minimum distributions? Have you ever had to deal with that? Were you shocked at the tax tables that you had, the taxes that you had to pay on you or your folks maybe, or maybe even your grandparents that you had when they had big RMDs? It's only getting worse as people live longer and longer and longer too. So you got to start preparing now, even though it's probably in the back of your mind and you haven't really worried about it or thought too much about it because it is so far down the road for you. But that time will creep up on you soon. Don't forget to hit the notifications button, the little bell there too, to be notified of future content. And we'll go into part 2 of this series next. I look forward to seeing you next on the Heritage Wealth Planning YouTube channel. Thanks.